Constructing your life is about much more than just building a bank account. Each week, join real estate entrepreneur and mindset coach Austin Linney as he interviews guests who are constructing their dream lives and impacting the world around them on a daily basis. If you're an entrepreneur or wanting to start a business, or you just want to hear motivating stories of how others have overcome the odds, you are in the right place. And now for your host, Austin Linney.
Guys, welcome back to Construct Your Life. This is Austin Linney here. I have the honor of having Mr. Travis Watts here. How you doing, sir?
Doing great, Austin. Appreciate it.
So this is the first time we're meeting in person, guys. You know this happens on the podcast from time to time. He is investor relations at Ashcroft Capital. They have a couple units. We're going to mainly talk about his educational stuff, how he's helping investors, passive investors, and then his own investing. He just got back from a vacation, so he should be rested and ready to fire some great knowledge, right, my man?
Just to clarify, we got back at almost midnight last night.
Oh, so he's
9 in the morning. So it's all right. It's all good.
So he's hanging in there for us. I appreciate it, my man. So why don't you tell us a little bit about your story? You can start wherever you want, man, and we'll just kind of get rolling from there.
Sure. Yeah. I'll just kind of recap my background quickly. I jumped into real estate in 2009 in single family homes. Didn't know what I didn't know. Didn't have mentors, coaches. Wasn't a big reader or podcast listener or anything at the time. Wish I had have been. And, from there, did some house hacking, rented spare bedrooms, got into fix and flips, got into vacation rentals, did everything myself, which was a problem. Tried to self-manage everything, tried to scale it up. Meanwhile, by the way, worked in the oil field, 100-hour work weeks, 14-hour days, away from home, out of state, worked in Saudi Arabia. It was crazy. So you can imagine I didn't have a lot of free time. And what free time I did have was pretty much solely spent on real estate and my tenants, turning over properties, trying to find more to buy. And so I burned myself out. I'll just fast forward to that stage in 2015. That was about 5-6 years into doing that model. And I thought, God, I love real estate. I love the tax benefits. I love cash flow, but I cannot be hands-on like this. This takes way too much of my time. And I naively thought back in the day that I would get to 50 or 100 plus single family homes. And I thought, it's just not going to be reasonable. If I'm going to be career focused first and do this secondarily, it's going to be way too hard. And so that's where I learned. That's where I doubled down on reading and podcasts, mentors, coaches, programs. And that's where my whole mind exploded. And I found ways to be a passive investor in real estate. So to invest in syndications and private placements and some REITs and other asset classes, self-storage and other funds and first lien notes, things like this, things that produced cash flow that had tax advantages oftentimes, but didn't require my direct time, commitment. So from 2015 through 2020, that was kind of my halfway point. So now we're another 5 years forward. And my passion is educating folks that are on similar paths in any capacity. And people, doctors, dentists, lawyers, attorneys, athletes, people that don't want to give up their career. This is what they do. It's what they went to school for. It's what they're good at. But they do want a place to park their capital, maybe not 100% in the stock market. So that's what I help do is educate in that space, share my stories and lessons learned and things like that, and kind of preach the passive side of real estate, if you will.
And it's funny that you say that, because this is a perfect kind of thing I've been on the last month is I don't think the passive side of investing is talked about enough, right? And I think that something that I have an issue with, because I have friends that have great jobs and they're like, no, I'm going to get all into I'm like, dude, you're making $300,000 a year right now. Why do you want to lose this? Maybe you went to college for 9 years. Maybe you've been working for 20 years. Like, I get it. Who doesn't want to be an entrepreneur, right? Yeah. But I think that I always use the analogy. I don't go into Discount Tire and tell them how to put the tires on my car, right? And, especially investors, real estate investors think they know everything, right? Like, I can just get into anything. And that's why some of them are losing their shirt in the stock market, right? And so I would imagine that this is why I love that you do that you find a lot of people, maybe they dived into a flip or maybe they dived into a couple rental properties, but they're a doctor, they're busy. And so I would imagine that you can show them a whole new world that they don't even know exists to make a return and to leave the headache at home, right?
I just didn't know it existed, to be honest with you. In 2009, if you had said a term like apartment investor, what does that look like? I would have said a billionaire, somebody with 30 years experience in real estate. I had no idea you could get in. A lot of investors that I work with, the first real estate deal they've ever done was a syndication. They never went the single family route. They went right into, I make good money, I need a place to put it. Oh, here's a spot. And it's more, perhaps more stable and predictable than, the stock market, for example. So, yeah, good point.
And I think where I want to stick for a minute, because maybe not a lot of people know, and especially where we're headed, and I think multifamily asset is scalable, is that what are you looking for? Because there are a ton of syndicators out there. There are a ton of operators out there that I don't think are being truthful with the numbers. So what are you looking for as a doctor, as a lawyer, or somebody that has some money to park with that's been sitting on the sidelines? What are the factors that you're looking for when you're looking for a partnership like that?
Yeah, that's a great point, because that is the trade-off. At the end of the day, what are you really investing in these private placements? It's people. It's a team. It's a track record. It's experience. To put that simply, it's the ability for this group to execute the business plan that they're pitching to you. How likely is that they can actually do that? That's what you're really betting on. So kind of my 3 points of hierarchy would be, I bet the team and the sponsorship as number one of importance. And number 2 would be the market and submarket. And number 3 would actually be the deal itself. And when I got started in 2015 and this side of the coin, I had that flip upside down. So I was looking all at these deals and trying to analyze these numbers myself, and analysis paralysis, right? It's easy to get caught up, especially with like an engineer type of mind. That's pretty common. So to your point, what do I look for? Well, I had to get clear on my goals and kind of my mission and what do I want to accomplish? What asset classes am I comfortable with? Well, I knew a lot about single family, but it was an easy leap going from the understanding of single family to multifamily. That's not a big leap, but to go from single family to mobile home parks, self-storage, office industrial, those are bigger leaps. And so for me, I wasn't as comfortable with that. So I kind of sought out to do this value add multifamily plays. And value add is just a theme in my life from childhood. Like value add to me is all about, I'm buying something used or distressed, I'm going to fix it up, and then I'm going to sell it perhaps for more than what I bought it for, and be able to utilize it in the meantime. You could apply that to a car. You could apply that to, a piece of furniture or something. I just like that concept a lot more than I like, buying a brand new car off the car lot, driving it, across the street and it loses 20% of its value, that kind of thing. So first the sponsorship team, aligning, my philosophy with others, making sure they're in the multifamily space, doing the value add components. Personally, because it's my income, I like monthly distributions. I like monthly reporting for frequency, so I can keep a pulse on these projects without kind of letting 2, 3, 4 months go by, especially right now in COVID. And so really what that's all about, I know I'm saying a lot right there, but it's just aligning what my mission and goals are, my criteria is, to a group that's doing just that, and that makes a really good partnership. And so I had the unique experience of going around before COVID to nationwide conferences, real estate meetup groups, meeting thousands and thousands of investors, a lot that were passive, and being able to just network. Who are you investing with, and what has your experience been with that group, good or bad? And I like to share transparently that way as well. So that kind of led me to find the groups that made sense for me. That was kind of the approach that I took anyway.
And it was, for me, it was interesting because I started in single family too, and I've been in the Airbnb space for a while, and now we're looking to get into multifamily. I had an epiphany when I was hanging out with my mentor up in Tahoe and a couple other financial guys. Yeah. I no longer bet on the deal, and the deal's important, but I have so much going on with my coaching business and other things going on. I bet on the jockey. not the
Yep.
horse. And
Yep.
so when I found people that specialize in something, why would I spend I need to know enough to not get screwed over, but why would I spend all my time learning about it if they specialize in it? And
Mm-hmm.
I think that's what y'all offer, is a steady hand to not get emotional in the wave of investing. And I think that's what people are gravitating to, especially in this day and age.
Yeah, and it's not an easy thing to do, but I remember my moment similar in the single family space where it was like, I was self-reflecting in the moment, doing this fix and flip, not even owning an electric drill, and just having to contract everything out and like watching my margins just shrink around me and thinking, I'm just not that good at this, quite frankly, like this is not really my calling. This is not my thing. And I knew I got introduced to more flippers as I was trying to network and figure things out. And I'm realizing they're doing this on a 4 or 5x scale from what I was able to do. And I thought, to your point, it's like, man, what if I just partnered with the people actually doing this right? The people that are like passionate and just burning desire and getting out there and making it happen. Why don't I just partner with them instead of trying to beat them, which I probably never would have, and I would have burned myself out that way too. So yeah, great point. And that's a lot to do with the syndication stuff. This is a business, doing a value add plan, there's so many moving parts. And, if that's not really your thing, your strong suit, then, the limited partner side might make sense.
Yeah, and what happened is Evan Holliday's a friend of mine in Nashville, and he invited me out to a Jake and Gino event, and we walked a unit with a guy who went from 500 units to buying 1,250 at a time. And I looked around. I swear to God, I remember it because all those guys are my friends. I looked around and I go, this is just a different environment. And moreover, the multifamily space seems to be such a family, right? And it's in that infectious, scalable mentality is what I live by, which is growth at all times in every way. And we have a tendency, especially men, alpha men, to say, no, I can do this. And I think me and you, I can feel your moment when you don't have a drill in your car. I've been there. I did it on a 1910 house in San Antonio, and we fired 3 contractors. And I'm like, true story. We teared the house apart, rebuilt the front, got to the kitchen. We were like, oh, we're just going to fix it. Well, we opened up one thing, and the rotting boards, the bottom boards were rotted out. And I was like, and I literally told my ex-father-in-law and my ex-wife, I said, give me a Red Bull, just leave, go to Home Depot for like 3 hours. And I just went in there and just demoed everything. I was so over it. Like, I think flipping a house to that scale is like the 7 stages of grief. Like, I didn't walk into it for a month, and but then I meet guys, and this is different from what y'all do, obviously, but then I meet guys, because I funded the deal, who made $200K wholesaling a multifamily. And then that's when the light bulb went off on the scale point of view. So kind of talk on to that when you're looking at an asset. A lot of my guys that listen are younger investors that are trying to get into multifamily. When you're looking at an asset, let's stay in the 20 to 30 range unit wise, just to make it easy for them. What are you looking for that is going to do alarm bells for you that this could be a great play to wholesale or to buy for yourself?
Yeah, it's a completely different space when we're talking 20 to 30 units, to your point. I took a leap from the single units to like 200 to 600 units where I'm partnering in these large deals. I totally skipped over that section. Now, with that being said, the way I see it, because a lot of people in my network, a lot of people are in kind of that mom and pop range, the 20, 30, 40, 50, 60, whatever, say 100 minus 100 units. They're often, not always, but often are higher returns that are achievable because you don't have as much, this is my personal opinion here, you don't have as much institutional capital chasing those assets, right? You don't have these mega REITs and insurance companies and pension funds looking for maybe a 20 unit. They're looking for a 500 unit, 1,000 unit. So a lot of people have kind of migrated up to that larger space, but pros and cons, it's gotten pretty crowded, So I've seen deals, honestly, people that have done these 20, 30, 40 units where they're doubling money in like 2 years. They're doing these opportunistic deals, these heavy value adds, And, they found it off market because there wasn't a lot of people chasing the asset class. Seems like a lot of people are in like the 4 unit or less, or all the way up to 200 and 600 unit, and then of course everything beyond that. But there's a lot of opportunity, I would say, in that range of the smaller deals. Now, you're talking more on, that's kind of an active question. What are you looking for there?
You're right. Yeah. I'm sorry, I caught myself. Okay, I'll change my question.
Okay.
There is a lot of opportunity from a young investor to find passive investors. So let's say you had 2 units, right? And you found a 20 unit that is a home run.
Okay.
You don't have the money, but there are guys that have the money that would look to invest in a deal like that maybe would invest in like a 200 unit, right? So what type of investors from your point of view, would you look for? Because I tell guys all the time, I don't care how much money's in your bank account. Go if a deal's a deal. So like if you're a young kid and you found a 24 unit, how do you go find the guy that has the money?
Yeah, so there's 2 primary approaches. Well, I should say 3 primary approaches, right? There's the individual buyer. They say, hey, I found this. I have the money. Boom, it's mine. There's the JV partnership. So you could have, maybe perhaps 2, 3, 4 people that go in together to collectively come up with that down payment and renovation budget. And that's not a syndication or private placement. So that's a joint venture where everybody has an active role in the business. Basically, someone's going to do this, someone's going to do that. So you're divvying that up. You don't necessarily have passive investors. And then if you jump up to the next level, which is a syndication, now you've got a general partnership team, whether that be you yourself or maybe 2 people or whatever it is. It could be unlimited. And then you have passive investors like myself, folks that are just saying, hey, I like the way that deal sounds. Here's $50,000. And hope that goes well. Send me my checks when they're ready, And so there's different approaches you could do to it. This is the thing I worry about right now in the space. Since 2015, it's gotten so heavy and so crowded with new syndication groups. Just I don't know how to really say this. You've got to bring some kind of experience to the table. So if this is your very first deal and you've never done this before, that's fine. I've actually invested with a number of those groups for various reasons, but they have always brought some kind of experience to the table, whether it was a co-GP and, well, hey, I've never done the deal, but my partner here that's doing the deal with us, he's got 20 years experience, or it's a coach or a mentor, someone's going to look over their shoulder, underwrite the deal with them, kind of check off, sign off per se. There just needs to be a level of that, because what I value most, like I said earlier, is what are the odds that this business plan is actually going to get executed. And I've seen it on both sides. I've seen very aggressive, as you pointed out earlier, people that, the numbers they look good on paper, but I can tell you up front, they're not going to happen. If you've never done a value add deal and here you're buying a 400 unit complete renovation, that's going to be very, very difficult. I'm not saying you can't do it, but you got to be realistic with that, how much of a value add. So at the end of the day, you got to have that network. You've got to have connections. It also depends too, if you're, not to get too much in the weeds, but you're doing a 506B or a 506C, whether you can publicly advertise this deal to get other exposure that way, or whether you have to rely on friends, family, and pre-existing relationships and connections, which again, you need a big network for that. You might need a few thousand people in your network to be able to come up with that money if they're doing 25K here and 25K there and stuff like that. So it's that whole realization that there's nothing wrong with passive. There's nothing wrong with active. It's aligning to your strengths. If you're that sales go-getter, connection builder, a lot of people, this is your skill set, this is your passion. Or whether you're more like me, saying that's a ton of work and a lot of time, and it's not necessarily what I want to be doing with my days or my weeks. I'm not really passionate about the business side of real estate. I just kind of want my money to grow and compound in a different way besides just the stock market. So
for sure. And I think that, and I'll switch to kind of what you focus on separate from your day job, I guess you would say, as an investor. But I think also and this is something that I harp on, and kind of what the whole podcast is about, is that I don't think people, they see a shiny object for investing and they want to go after it. They want the new thing. And that's why Airbnb is so hot, or whatever you want to call it. And everybody got caught with their hand in the cookie jar during COVID. And I think some people are paying for it. But I don't think enough people sit down with their spouse or themselves and say, what matches my lifestyle? Meaning, what do I really want? And I think that's the opportunity that you're giving to your investors and saying, you can go make money or spend a week in France on a beach. Like, we're going to go make sure that your capital is working for you. And I think that's kind of what you've unlocked with your life, which I think what everybody's searching for.
It is. And I just like the model so much more. So when I left, so my FI number, my financial independence, whatever you want to call it, happened in 2015. That was when I was at the oil field job and I was burning out and blah, blah, blah. Well, I had done, for the first time, I'd done like a true, honest, conservative net worth calculation. So that if I sold all my single family homes, I paid all the taxes, I paid all the fees, what am I really left with? And if I took that amount and I conservatively put that into these deals, knowing some will not perform and some will overperform, and let's just find a lower average there. What would that mean? Well, that amount of cash flow to me meant I could leave that oil field job to go pursue work that I actually wanted to do. And I took that. I mean, that to me, that was my biggest motivator at the time. And it's something I talk a lot about on a personal side is time freedom. This passive income, truly passive income, not the kind that every other weekend you're having to go out and repair the houses and stuff, but like truly passive income. When that exceeds your lifestyle expenses, you just have more flexibility and freedom, whether you want to move from full-time work to part-time, whether you want to move, whether you want to travel more, whether you want to spend more time with friends and family. Everybody kind of has their why and what would you do if money weren't the factor, blah, 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 all those kinds of questions, right? But that's really what my pursuit has been about. So I went and worked for a brokerage account, or I mean, not a brokerage firm, right after reaching that FI number, because I thought, hey, if I could learn stocks, bonds, and mutual funds and real estate, I mean, how smart would I be, right? But I fell out of love very quickly after, getting licensed and all that good stuff, because to your point earlier in our conversation, you pointed out something really critical, and that's that it's like a family culture in multifamily real estate. Everybody kind of knows everybody. Everybody's helping everybody. And most importantly, when I'm investing in a deal, say you're the GP putting on this deal, you're going to have more often than not skin in the game. You're going to be putting your own money in that deal saying, hey, look, I really believe in this myself. And maybe even my friends, my spouse, my family, like we're investing in this too. So if I fail to do my job, I lose in addition. And that's something that wasn't there on the Wall Street model, right? It's pushing this stuff that I myself wasn't invested in and telling other people that's what they should do. And I just couldn't stomach it. I had to quit. So
that's a really good point. And I didn't think about that till you made that point, is that when you're starting out, right, especially in my early 20s, I'm like, I have the idea. It makes sense, right? But nobody would take the chance, because I realized that I needed to go out and take my licks myself. And then once they saw me get beat up, then they were like, okay, he's had some seasoning, like, we know. Because what I love about multifamily opposed to a flipper or like a wholesale deal is, yes, it's about the number. Obviously, people want to get their money. But when you can signify as a group that you can close deals, that's when you can get a lot more deals. And that's what I love about multifamily, is when you close a segment of deals, then they'll know you as the closers and they'll come to you. And I think that's what's so exciting, because as a team, don't you feel like you can kind of build that momentum, which is not talked about enough in real estate, is momentum, right?
Yeah, exactly. And that's just, not to go real deep on the Ashcroft Capital side, but so many of the deals being presented to Ashcroft are being presented to them either exclusively or them and two other groups in a quote unquote off market situation. So if you and I partner up and we want to go chase those same assets, we wouldn't even have a chance to see them, because they've got such the momentum, the track record, right? That they're always bringing the money to the table. They're always closing. They're not retrading. They have a good reputation. Brokers know them. That's where the deals go. So it takes some time to establish that. Yeah, to your point.
For sure. And on the personal life side, because I'm big in, you don't know much about me, but I've lost a bunch of weight. I had an alcohol problem. I got sober and all that stuff. You're well put together. You're in shape, I can tell. Like, what is your daily intake on the personal development side opposed from the investing, which for me is really what all me and my mentors talk about. I couldn't even tell you the last time we had a conversation about real estate. We're talking about family, kids, life, what we want to do, right? And I'm trying to create what you're talking about, which is passive. So I was just on the road for 6 months. I visited 16 states, worked from my laptop. And that was kind of like a test case scenario for me, like, can this happen, right?
Yeah.
So now we figured out some stuff. So I want to hear about your personal development space, kind of your lifestyle, more of that stuff.
Yeah, my wife and I, so we're both really big into self-education. She's more on like the diet and fitness side of things. I'm more like on the finance side of things. And so together that makes a pretty good combo. Yeah. We're always experimenting with different diets, from raw vegan stuff to celery juicing. And we do smoothies and wheatgrass stuff and all kinds of crazy things. We're always just experimenting with that. On the finance stuff, have you watched the documentary called Playing with Fire that came out last year about
No, I haven't.
So that was a really eye-opening movement. And I didn't really realize this myself, but I was raised by two very frugal parents, in childhood. And they taught me so well one side of the coin, which is, how to save and live below your means and use coupons and buy the off-brand and don't buy things you don't need and don't keep up with the Joneses. And, so that was great to get that like hardship course early in life. But I was taught zero about investing. And so I just kind of knew after reading a few books, which was something my family wasn't big into, is reading, that was my opportunity, right? It was to take that foundation and then leap over it, into that stuff. So anyway, my point in mentioning that documentary. So FIRE, for those listening that aren't familiar, is Financial Independence, Retire Early. It's an acronym. Get some heat on the retire early end. Some people, why would you want to do that? Whatever. But to our point with time freedom, right? It gives you flexibility and options and things like that. So point is that what we've done is kind of a 4-step process. This is really like how I got there, so to speak, right? So you earn as much as you can using your highest and best use of your time. For everybody, that's going to be different. For me, that was an oil field job. That was fixing and flipping houses, launching small businesses on the side. Then you live on as little of that as possible for a period of time, not your whole life, just say 5 or 10 years, whatever it may be in your circumstance. And then you take that margin from what you earn and what you live on, and you invest all of that, not save, but invest all of that, in my case, into cash flowing assets, right? Which then I had more cash flow than lifestyle expenses because I live pretty frugally and modestly. And then the last thing is just avoiding bad debt, credit card loans, student loans, car loans, whatever you can avoid. If you have them, pay them off. If you don't have them, don't get them. And that was really it. And this whole FIRE movement is around this like modern day era of like more millennial based, mindset, saying we don't really enjoy this corporate world stuff. It pays well, but can't really see myself here till I'm in my 60s or 70s. So what if I just gun it for like 10 years and stock it away? I can then have that freedom. To your point, I can go travel for 6 months. I can go live van life, RV life. I can go, whatever you want to do. And so it's more of I don't like the word like work-life balance, but it's more of that, right? It's more of the alignment of what you truly are passionate about and want to do. So I know I kind of got on a rabbit trail there, but that's kind of my.
He just gave you the blueprint. If you don't back that up and play that every morning when you wake up, and it sounded really simple, but it was so important. That was everything.
It's simple on paper. It takes willpower, perseverance, discipline, but you can do it. I mean, literally, no matter what age you are, give 5 to 10 years of that kind of strategy, you'll be so far ahead. Just that alone.
And it's weird because now I live in no, I'm not suggesting it for everybody. So let's just say I preference that. I live in 250 square feet, right? But we're just south of Austin. We live on 5 acres with some other people in a tiny homes where the bills are low. I'm getting ready for whatever comes, right? From the backside of whatever's happened. And then there's opportunities to invest where my money can be spent in other places to get me ahead. And so many people look at our lives, because I'll be 39 in December, right? And my 20s, we don't know what that was over there. But then the last couple of years, really focusing on investing, getting the stuff into, you can really take, like you said, 3 to 5 to 6 years. And technically you could be retired like in that amount of time if you really get disciplined and focused. And that you act like that's such a long time of your life. It's really, a point of a percent of your life. And I think people get mistaken that you have to slave away for 30 years to get to where you need to go. And that's not the case. You showed that.
It's totally not. And if you look at the stats, this was another huge pivot, like epiphany for me, right? Is look at, like, I love the average American stuff or the median, this or that. I love those types of stats. And when you look at what people in their 60s and 70s today in 2020 are retiring on in terms of income, and then you compare that to what you can do in real estate, to your point, right? 30, 40, 50, 60 years working, in an industry to get to maybe $2,000 per month in income through maybe Social Security and a half-ass pension if it lasts, or a 401k till you deplete it, whatever it may be. Guys, you can get there in a matter of 5 years, sometimes less. You can get to the same result.
Dude, I was on a podcast the other day, and this is what drives me crazy. I feel like a group of people, especially because I'm around a lot of Airbnb operators that manage a ton of properties. I feel like you get in a group of a room of 10 people and they have a lot of assets. I feel like it's an Airbnb support group because we're all like want to cry, and it's a nightmare, and they're like scaling back or whatever. But what people don't understand, same thing with multifamily. You could own 3 Airbnbs and clean them yourself if they were highly profitable and retire. You could own, my buddy Tyler Chester, you could own a 50 unit yourself, and it could be cash flowing enough for you to retire. That's where they get mistaken. They need a unit count or a number that matters, and it doesn't, because all that matters is the number that you need to be comfortable. That's it. And it doesn't look like everybody else's.
We just, you mentioned at the beginning of the call, my wife and I just got back from North Carolina, and we were up in a beautiful neighborhood outside Asheville, and we stayed in an Airbnb. It was actually VRBO, but whatever, short-term rental. So I researched this property as we were there. These folks in 2018 bought this property for $135,000. They put maybe 50 to 75K into it in renovations to update it. We paid $2,700 for 7 days. I mean, anyone that can just run some simple numbers there and you kind of do the math, incredible, to your point, incredible. I mean, we were thinking about the same thing. I thought, man, if you had like just 3 of these, And,
well, I mean, you look at it, and I'll just give you a case study. Are you familiar with Austin at all? So
we've been there, but
So you have Round Rock above it, which is 25 minutes north, suburb, right? It's a suburb. Okay. That's all it is. I ran a property for one of my best friends. The note on the property was $1,100 a month, all in, and he was bringing in. We were bringing in $2,900 for him a month, and I'm like, you don't need more than 3 or 4, and you're good. Like, and the house is paid off in 5 years, like. And but it's so sexy, right? To say, ooh, I've got 1,000 units. Yeah, you also have 1,000 headaches. And so this is what I'm trying to get across to people, is make sure that your goals and your intentions are set for you. And the way to do this, and I would imagine you do with your wife, you sit down and have intentional conversations with your partner about what do you actually want it to look like, instead of caring about what it looks like on paper, right?
Yeah, no, totally. And that's you do have to make time for that. we usually remove ourselves from the day to day. We're not in like our typical routine. So we'll go out to a park or on a walk or a bike, or not really a bike ride, but whatever. We'll remove ourselves and we'll sit down knowing what we're going to be talking about ahead of time, having prepped for that a little bit. And then, just a focused conversation. Doesn't have to last that long, but just take, 15 to 30 minutes and just talk through this stuff. One that we were doing the other day that came from that documentary I pointed out, Playing with Fire, was writing down this. Let me give you a quick backstory on this thing. So it's a couple out in San Diego that are more or less living the American lifestyle, keeping up with the Joneses, the BMW, the beach house, blah, 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 right? But yet broke. And so they go and discover this whole FIRE movement, networking with the people that are big advocates for it and learning from everybody. And so what they did before they left San Diego, not knowing they were going to leave, is they sat down and said, what are the 10 most important things to us? Week to week, month to month, day to day, whatever, what's most important. And it's stuff like spending time with my baby, eating chocolate, having a nice bottle of wine on occasion. And it had nothing to do with San Diego, the beach, the BMW. And so it's like, wow, you're putting all your money into things that aren't even bringing you happiness, that you are saying aren't that important in life. And you could have those things that they listed anywhere in the US. So they end up in Bend, Oregon or something. Yeah. But it's it's interesting to do those.
So I don't want to go down a rabbit hole with this, but I would love to hear your opinion. This is why I think that because of COVID and people working from home and not having to live in these expensive cities anymore, I think as an investor, you need to be looking in second and tier markets. I think that you're going to see a movement, right? Am I wrong or not?
No, 100%. It's like been my focus for the last 2 months is on YouTube, listening to people's perspectives on why they're leaving California, why they're leaving New York City, and understanding, not just focusing into a bias or something, but just anyone and everyone that's out there talking about their rationale and what they're seeing and why. And it's really interesting and it makes a lot of sense.
So true story. Last 3 days, I've had 7 investors reach out to me from California or New York. They're moving to Texas.
Yep.
They're changing it. But here's not the weird thing. I was in Dallas the last 2 days visiting investors. Nobody would know this outside. I shouldn't tell everybody, but I don't care. Dude, Oklahoma is blowing up. You can't even buy property in South Oklahoma and stuff. And so don't be so focused on these major cities, guys. I know a friend who has 35 units in smaller cities in Michigan, and he's killing it because rent is jumping 200% in the last 2 years. So make sure you're really doing your homework, right, on these markets and understanding why. That's what I love, why people are moving there.
Oh, yeah. That's one of my biggest things. And I talk about that too. We can take that from the LP perspective real quick. So what I do is it's the irony of being a passive investor full time, but yet it's got some active components to it, right? It's not just literally hands off mailbox money. You have to do some research, connections, and vetting deals and sponsors. But I go macro level with this stuff. To your point, I look at where people leaving, where are they moving to, what are the reasons behind it, what do those numbers look like, what are the forecasted growth and rent and all this from a macro level. So I know, Texas is a great spot, Florida, whatever, in general. Then I let the GPs and the sponsorship team fill me in on the very specifics on the submarket. What about Irving, Texas? What about Lubbock, Texas? What about, Jacksonville, Florida? Florida's not created equal, right? Miami real estate is not Jacksonville real estate. So you've got to understand at least from a macro level what's going on, and then you can dig in deeper, be fed that information elsewhere.
And it's funny because I have a couple friends and I ran Airbnbs in Lubbock, Texas, which as a Texan, there's no chance I would ever think that I would ever be in Lubbock, Texas, and it's a monster drive, but it's the market's hot, and so don't. And this is what I tell people about Airbnb: don't let your ideals and your thoughts and your context cloud your judgment on why people are doing something, because the numbers make sense, and you can't, just because you wouldn't live there doesn't mean other people wouldn't live there. Maybe they're looking for something different, right? And this is about understanding movement, and things are changing, and they change very quickly, right? And Idaho is becoming hot. And we just spent a week in Utah. I'm in love, and so these are things that are going to be popping up. And more importantly, my dream, if we can go off on a tangent, my dream is to create a small town. because I worked in hospitality for 20 years and I know what it takes to build a community. And I think it's the coolest thing in the world. You get these small Texas towns that all of a sudden you look back and in 4 years, they've got this budding community, right? And I think there's so many factors at play that people don't focus on because you're just looking at deals instead of the movement of people.
Yeah, 100%. Yeah, go buy a ghost town and make it an Airbnb town. That'd be cool.
Yeah, I mean, you could just have some weird structure in the middle. But what I want to do is, because I want to respect your time and wrap it up here. If you're a new investor, let's say you're in the single family space and you're looking to make the transition, what are you telling them are the factors they should be focusing on, like you did?
Yeah. So here's the deal. I've gone too extreme on too many occasions. Okay. So start with a little bit of self-education, get to the point where you're comfortable understanding like why real estate, for example, or why certain markets or why this, just that's your education piece. Then self-reflect, right? What am I good at? Do I want to be hands-on? Do I want to be hands-off? Who do I know? What's my network? That kind of stuff. And then that's kind of where it divides up into the active and passive routes, right? And again, there's not one that's right and one that's wrong. It's pros and cons. There's a lot of money to be had in either case, probably more on the active side, but then you're exchanging your time for it. So again, like for my wife and I, we're world travelers. We travel all the time, domestic and worldwide. And so for us, we cannot be pinned down to an area doing active work. I mean, that would just take away our life dreams, so that was a lot of self-reflection. Without knowing that, we would have just got into everything, and not known what the outcome is. So get organized, get clear, goal set, self-reflect, write down your criteria, educate. And real quick story on the education piece. I'm telling you, in 2015, I went too extreme and I made a goal. I said, I'm reading 52 books this year. That's a book a week. And I'm doing it, and I did it, and it was not a good idea. I learned a ton, yes, but I only retained a fraction of it. And at the end of the year, I had taken virtually no action, very little. And all in all, I look back on that, and I think that was kind of a waste of time. To be honest with you, I'm not saying reading's a waste of time. I'm just saying I should have read like 3 or 4 books and really taken it home and taken notes and done a self-study and shared that with people, and then gone out equally to take action in implementing some of that. So finding that balance, that's my advice. Find that balance.
No, I love it. And that's an amazing experience because I was walking a flip in Arizona with one of my mentors the other day, and he looked at me and he goes, I don't think you like this as much as you thought you did 2 years ago. And I'm like, I think you're right. because I did and when I say I did the active, we had 27 Airbnbs in 7 states, and I was running the show. And my phone, I got 60 to 85 messages a day. Mm-hmm. And I looked at it, and this is what I thought I wanted. And I was miserable. And I go, no. I'd much rather be the bank, a passive investor, because that allows me to do what I truly was put on this earth to do. And that's support people, lift people, educate, coach people, change their lives, right? But we too much get in a hole or get in a job, and we go down this deep hole, and we can't pull ourselves back out because it's too scary to jump out of the comfort zone, right? But you really have to look inside and go, I don't really want this. And if there was ever a time to make a pivot and maybe sell some properties because the market is hot, to sit back and really look at your goals, this is a perfect opportunity. I think this year has been that for everybody if you choose to look at it that way.
Yep, exactly. And one more thing I want to add to that is that, so you've got cash flow and passive income, and then you have equity upside. Now, I'm asked quite frequently that if I were to start over in 2009, would I have just started as a passive investor? My answer to that is no. And that's kind of interesting to think about because I'm so passionate about it today. But here's the facts. I didn't have a lot of money to work with in 2009. Had I put 100% of that into a passive deal or a REIT or whatever, I would have had, $100 a month passive income. That wouldn't have been life-changing. It wouldn't have, kept my attention. I could have discredited it and said, I'm just going to sell it and go buy Bitcoin and see how that happens. And then I could have taken a whole different path, but, so the equity is important. It depends on how you earn your income. I think everyone needs to, again, highest and best, income, and then living frugally for a while, kind of investing that difference, right? To where now you look back and say, wow, now I have, 3, 4, 5,000 a month passive income. Well, that kind of matters. That's a bit of a life changer for a lot of people. Mm-hmm. And it was kind of at that transition point that, I took that path, so something to think about.
I love it, man. So how, you got your content on social media is great. So much education, so much valuable information. How do people find you? What is the best way to get a hold of you if they want to?
Yeah, what I do is I give back my time. So for free, 15-minute phone calls, Q&As from podcasts, from blogs, anything I do. Anybody out there is welcome to set up that call with me. I don't upsell anybody on anything, but how you find that is ashcroftcapital.com/connect with Travis. You can it's a Calendly link. You click it, find a time that works for you. Boom, we'll have a 15-minute call. I'll help in any way I can, add value. That way, in addition, if you want to learn more about private placements and how this stuff works in syndications, I have a guide. It's a downloadable 20-page guide, and you can get that at the same place. And so it goes over industry terminology, how to vet sponsors, questions to ask, deals, markets, all that good stuff. So find them both there. To your point with content, Instagram and Facebook are at Passive Investor Tips. And then I'm on, Bigger Pockets and LinkedIn and all that good stuff too. So however you want to reach out, please do. Happy to be a resource and help whoever I can.
Well, I really appreciate your time, my man. We got so much value from that. And thanks so much for coming on, guys. And if you enjoyed this episode, make sure you share it with your friends, guys. And we'll see you next time.
Thanks so much.
Thank you for listening to Construct Your Life with Austin Linney. If you enjoyed this episode, be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, take this opportunity to start constructing your life by taking immediate action on what you learned. For show notes, resources, and more information on one-on-one coaching with Austin, visit constructyourlifepodcast.com.